The IRS changed the 1099-K rule 4 times in 4 years, and the latest version has a trap almost nobody is talking about. If you've sold anything on Etsy, eBay, PayPal, or Venmo this year, there's a $20,000 number you need to understand. Here's the short version. The government was about to track every single online transaction over $600. That plan got killed. But what replaced it is more confusing, and in some ways more dangerous than what came before. By the end of this video, you'll know exactly what the $20,000 1099-K threshold means, why it doesn't protect you the way you think, and the 5 steps every online seller needs to take right now to avoid a surprise from the IRS. Here's why this matters to you specifically. 1 in 3 Americans now has a side hustle. 44% of those people sell products online. We're talking about 80 million people generating over $80 billion a month in extra income. If that includes you, this video could save you thousands. Quick note before we dive in, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Now let me show you where this whole mess started, because the backstory explains everything. Back in 2021, Congress passed the American Rescue Plan. It was a massive bill, trillions of dollars in spending, but hidden inside was a tiny change with huge consequences. They lowered the 1099-K reporting threshold from $20,000 down to $600. What does that mean in plain English? It means if you sold $600 worth of stuff through PayPal, Venmo, Etsy, or eBay, the platform would have to report it to the IRS. Not $600 in profit, not $600 after shipping, $600 in total transactions. Think about that for a second. You could sell a used couch and some old textbooks, hit $600, and suddenly the IRS gets a form about it. But here's what makes this worse. Even though the federal threshold sat at $20,000, while the IRS kept delaying that lower rule, some states never waited. States like Massachusetts and Maryland still report you at just $600. New Jersey, $1,000. So you could get a 1099-K in your state mailbox and have zero idea why. At least 5 states right now have thresholds at or below $1,000. That means even today, depending on where you live, the safe threshold might be way lower than you think. So what actually happened at the federal level? Let me walk you through the full timeline, because this is where the confusion lives. And once you understand it, everything else clicks. In 2021, Congress passed the $600 threshold. It was supposed to start in 2022. Then the IRS delayed it. They said they weren't ready to process that many forms. They delayed it again for 2023, same reason. Then in 2024, instead of going straight to $600, they set a transition threshold of $5,000. Then they announced a phased plan, $2,500 for 2025, $600 for 2026. The full drop was coming. 4 changes, 4 years, and every time, sellers were left guessing. Do I need to worry or not? Am I going to get a form or not? But then something big happened, really big. On July 4th, 2025, the One Big Beautiful Bill Act became law. And buried inside that bill was a complete reversal. The $600 threshold? Gone. The $2,500 threshold? Gone. The threshold went right back to where it started, $20,000 and more than 200 transactions. And here's what really shocked people. It was applied retroactively, all the way back to 2022, as if the lower threshold never existed. So the law basically said, forget everything you heard for the last 4 years. We're going back to the original rule. Sounds like a win, right? Sounds like you can relax? That's what most people think. And that's exactly where the trap is. Here's what the $20,000 threshold actually means. It's a reporting threshold, not a tax threshold. Let me say that again. It controls whether the platform sends you and the IRS a form. It does not control whether you owe taxes. Every single dollar you earn is taxable, whether you get a form or not, whether you sell $500 or $50,000. The IRS expects you to report all of it on your tax return. This is the #1 mistake online sellers make. They think, I didn't get a 1099-K, so I'm in the clear. That's like saying the speed camera didn't flash, so the speed limit doesn't apply. The form is the camera. The tax is the speed limit. They're two completely different things. And the IRS has said this explicitly on their own website, in their own FAQs. All income must be reported regardless of whether you receive a 1099-K. So what does this mean in practice? Let's run through a real example because the numbers tell the full story. Let's say you sell vintage sneakers on eBay as a side hustle. You love finding deals at thrift stores and flipping them online. Over the course of 2025, you sell 150 pairs. Your total sales come to $18,000. That's below $20,000. And 150 is below 200 transactions. So eBay does not send you a 1099-K. No form, nothing in the mail, nothing sent to the IRS. Feels safe, right? Here's the reality. You bought those sneakers for an average of $60 each. That's $9,000 in inventory costs. Your actual profit? $9,000. You owe self-employment tax and income tax on that $9,000, period. No form changes that. No threshold changes that. That's your taxable income. Now let's flip the scenario. Say you crushed it this year. You sold 300 pairs for $25,000. Now you've crossed both thresholds, over $20,000 in payments and over 200 transactions. eBay sends you a 1099-K, but here's the second trap hiding inside that form. That 1099-K shows $25,000, the gross amount, not your profit. It doesn't subtract shipping costs, it doesn't subtract the cost of the sneakers, it doesn't subtract eBay's fees or PayPal's cut. Let's say your actual costs were $17,000 between inventory, shipping, and platform fees. Your real profit is only $8,000. But the IRS received a form showing $25,000. If you don't keep detailed records, you can't prove the difference. And the IRS will start with that $25,000 number. That mismatch between what the form says and what you report is exactly what triggers letters, audits, and headaches. And coming up in a few minutes, I'll give you the 5-step checklist that prevents all of this. But first, there's a third piece of this puzzle that trips up even experienced sellers. The $20,000 threshold only applies to what the IRS calls third-party settlement organizations. That's a fancy way of saying platforms that sit between buyer and seller. Think PayPal, Venmo, Etsy, eBay, Cash App, Airbnb. These are all third-party settlement organizations. The $20,000 and 200 transaction rule applies to them. But here's the catch almost nobody talks about. If a customer pays you directly with a credit card, debit card, or gift card, there is no minimum threshold. $0, 1 transaction, 1 penny. The payment card processor can report it. So if you're a freelancer using Square or Stripe and your clients pay by card, which most of them do, you could get a 1099-K for any amount. The $20,000 rule doesn't apply there at all. This catches small business owners and freelancers off guard constantly. They think $20,000 is some kind of universal shield. It's not. It only applies to specific types of platforms processing specific types of payments. Why does this matter so much right now? Because the gig economy is massive. Over 36% of Americans have a side hustle. More than half of them started in the last year alone. And 73% say they're doing it out of financial necessity, not as a hobby. These are real people trying to make real money, and the tax rules around their income are more confusing than ever. That's why the IRS put tax misinformation on social media in their 2026 Dirty Dozen list. They know people are getting bad advice online. Viral posts telling people they don't owe taxes under $20,000. That's wrong, and it's landing people in trouble. Now here's something else you need to know. Even when no 1099-K is required, the platform can still choose to send one. The IRS confirmed this in their own FAQs. Platforms are allowed to issue a 1099-K at their discretion, even below the threshold. So you might do everything right and still get a form. And when you do, you need records to back up your numbers. All right, Enough about the problem, let's fix it. I call this the side hustle tax survival checklist. 5 steps. Do all 5 and you're protected. Skip even one and you're leaving money on the table, or worse, leaving yourself exposed. Step 1. Separate your accounts. This is the foundation of everything. If your PayPal account handles both personal payments and business income, you're creating a problem that's invisible until tax season. Here's what happens. Your friend sends you $40 for dinner on Venmo. Your Etsy customer pays you $40 for a handmade bracelet. Same amount, same app, completely different tax treatment. But Venmo doesn't always know which is which. If the platform counts personal transfers as business income, your 1099-K could be inflated. And explaining that to the IRS is not fun. The fix is simple. Open a separate account or profile for business activity. Most platforms let you create a business profile for free. Keep personal money in one lane, business money in another. Never mix them. Step 2. Track every sale and every cost. Every single one. I'm not talking about doing this in your head, and I'm not talking about, I'll figure it out in March. I mean a spreadsheet, a free app, or basic accounting software. Recording every item you sell, what you paid for it, your shipping costs, platform fees, and packaging expenses. Here's why this is worth your time. Say your 1099-K shows $22,000 in gross sales. If you can prove you spent $14,000 on inventory, shipping, and platform fees, your taxable profit is only $8,000. Without those records, the IRS sees $22,000 of income, full stop. That difference, $14,000 in deductions, could save you $3,000 to $4,000 in taxes. That's $3,000 to $4,000 you lose by not spending 20 minutes a week on a spreadsheet. Think about that. Step 3. Understand your state's threshold. This is the step people forget because they assume federal rules are the only rules. They're not. Go to your state's Department of Revenue website. Search for 1099-K requirements. Find out your state's specific reporting threshold. If you're in Massachusetts, Maryland, or the District of Columbia, the threshold is $600. Vermont and Virginia also have lower thresholds. New Jersey is $1,000. If your state has a low threshold, you need to plan for receiving a 1099-K, even if you're a relatively small seller. Don't let it catch you off guard in January when a form shows up that you weren't expecting. And remember, even states that share the federal threshold might have different rules about what counts as a reportable transaction. 5 minutes of research now saves hours of headaches later. Step 4. Set aside money for taxes as you earn it. This is where most side hustlers completely fall apart. They earn money from January to December. They spend it from January to December. Then April arrives and they owe $2,000 they don't have. Sound familiar? Here's the fix. The general rule is to set aside 25 to 30% of your net profit for taxes. If you made $8,000 in profit over the year, that's $2,000 to $2,400 you should have tucked away. Open a separate high-yield savings account. Label it taxes. Every time money comes in from a sale, calculate your approximate profit and move 25 to 30% into that account. Don't touch it, don't borrow from it, pretend it doesn't exist until April. And here's a bonus tip. If you expect to owe more than $1,000 in taxes for the year, the IRS actually wants you to pay estimated taxes quarterly. That means making payments in April, June, September, and January. It sounds annoying, but it avoids underpayment penalties that can add up fast. Step 5. Know the difference between a hobby and a business. This is the step most people skip, and ironically, it's the one that saves the most money. If you sell your old couch on Facebook Marketplace for $300, but you paid $800 for it 5 years ago, that's not income. You sold a personal item at a loss. No tax owed. You don't even need to report it. But if you're buying items specifically to resell at a profit, thrift store finds, clearance deals, wholesale sneakers, the IRS considers that a business. Even if you never registered a company, even if you don't think of yourself as a business owner, the IRS doesn't care about your business cards. They care about your intent. Why does this classification matter so much? Because it changes your entire tax picture. A business reports income and deductions on Schedule C. You pay self-employment tax of 15.3% on top of your regular income tax. But you also get to deduct legitimate expenses, shipping costs, packaging materials, platform fees, mileage to the thrift store, a portion of your internet bill, your phone plan if you use it for business, even storage space. A hobby? You report the income, but you can't deduct any of those expenses against it. Let me show you what that means with real numbers. Say you sell handmade candles, $9,000 in total sales, $7,000 in supplies, packaging, shipping, and platform fees. Your actual profit is $2,000. If the IRS treats this as a business, you pay tax on $2,000. If the IRS treats this as a hobby, you pay tax on $9,000, the full amount, no deductions. That classification alone could mean a $2,000 difference on your tax bill. Maybe more depending on your bracket. So how does the IRS decide? They look at several things. Do you keep organized records? Do you have a genuine profit motive? Do you put real time and effort into the activity? Have you made a profit in at least 3 of the last 5 years? The more yes answers, the more likely it's a business, and the more deductions you can legally claim. If you're serious about selling online, even as a side hustle, set it up like a business from day one. Keep records, track expenses, show the IRS you're running this with intent. So let's bring it all together. Here's where we are right now in 2026. The $20,000 1099K threshold is back. It applies to platforms like PayPal, Venmo, Etsy, and eBay. You need both conditions, over $20,000 in payments and over 200 transactions, before the platform is required to report you at the federal level. But that doesn't mean you're in the clear, not even close. The threshold is about reporting, not about what you owe. Your state might have a much lower threshold. Credit and debit card payments have no threshold at all. And every single dollar of profit is taxable, whether or not any form ever arrives in your mailbox. The IRS has made this crystal clear, and their 2026 Dirty Dozen list specifically calls out misleading tax advice on social media. If someone online told you the $20,000 rule means you don't owe taxes, they were wrong, and following that advice could cost you. The side hustle economy is real, it's massive, and it's not going anywhere. 80 million Americans are part of it. 44% of them sell products online. Together, they're generating more than $80 billion every month in extra income. The IRS knows, the platforms know, and now you know. But this isn't about fear, it's about being prepared. It's about keeping more of what you earn instead of giving it away because you didn't know the rules. The 5 steps I gave you today, they take about an hour to set up. 1 hour. That single hour could save you thousands of dollars in taxes and a whole lot of stress every April. That's the move. Money made simple. If this was useful, you need to see this next. There's a $25,000 rule about tips that the IRS barely talks about, and it could affect you even if you're not a server. It's called the $25,000 tip rule nobody talks about. I'll link it right here.